Hi guys, I hope you guys are good. This is another video, another jam. This is part four of the series of the 7-Eleven series. So today we're looking at US30, which is Dow Jones. I don't personally trade US30. I only trade NAS 100. Um, so that's my go-to pair that I trade. It's NQ or in Bitcoin. So those are the only ones that I trade. I don't do Forex. I don't trade US30. But the model works for every asset class. Doesn't matter what pair you're trading, whether you trade bonds, you trade um, anything. You trade crypto, you trade forex. Like it works for every single pair, as long it has, as you know, the specific times of where to find opportunities and where to exit. I had a comment on my previous video. A gentleman asked me about the timing. So basically, this is 1 a.m. The beginning of where you have to start hunting for opportunity. This is 1 a.m. and up until 5 a.m. This is the morning session, which is 1 a.m., 5 a.m., which is the London session. As you can see here, the price traded up until 5 a.m. to the tick. After 5 a.m., the price started to consolidate. It didn't have a bias, but to show that the model has works on a specific time of the day, it's good to check for price from 1 a.m. to 5 a.m. New York time, which is here. You need to make sure that your time is being set to New York UTC, which is this one. It's set for New York UTC. So basically, I call it a 7-Eleven because in my time, as I said in the previous video, in my South African GMT, 1 a.m. in the morning, it's 7 a.m. in South African time. And 5 a.m. in the morning, it's 11 a.m. South African time. And again, the model comes at 7 a.m. New York time and 11 a.m. New York time, which on my side is going to be 1 a.m. and 5 p.m. So I hope you can see the correlation between the significance of the 7-Eleven when it comes to timing. So if we can just get the timing correct, it's going to be easy for you guys to find this model. So as we start here, so we have the midnight opening, which you don't forget to mark every time. This is the first thing you need to do is to mark the midnight opening candle. After figuring out the midnight opening, you wait for the 30 minutes midnight opening range. This is basically a range of the opening of the session. So what you do, you just mark for, if you want to find the target, you just use your Fibonacci and you measure from this low here up to this high here. And then you can see in this case, we have the second standard deviation, which is where the target went to. Um, Above the standard deviation, we have buy side liquidity with the 1 minute fair value gap. So let me just mark this deviation here. This is the second standard deviation. As I told you on the previous videos, the Fibonacci settings, I'm gonna be I'm gonna be sharing it once we able to go live on our live tradings. So the Fibonacci setting that I use are very straightforward and they're very simple, but I'm not gonna share it for now. I'm just gonna share it until I make my live streams. So that's where I'm gonna be sharing my Fibonacci settings, my Fib extension settings. So what do we have here? If I can just go back in time. So right here we have this relative highs here, which is the buy side liquidity. Then we have this fair value gap with the actual gap here, which is a liquidity, not a liquidity void, but a volume imbalance. So we have a fair value gap that's been accompanied with volume imbalance, so it makes it a good drawn liquidity. So now that we have the narrative that the price is going to be going higher, we wait for the 1 a.m. candle, which is here. We wait for price to create relative highs and relative lows. So in this case, the price traded lower and then it traded higher without having a clear, like it did on NQ. It did the same thing on USDT because they go together most of the time. So now that we have this lows here, the lows of it, they were not taken out. So if this sell side wasn't taken out, it's not a full setup that you need to trade because you need to have rules. You need to stick to your rules. And if your rules say the sell side liquidity needs to be taken first before going to the buy side, then you need to wait for the sell side to be taken out. If the sell side are not taken out like this, that means it's not your actual model. You just have to wait until it gets to the point where it creates relative highs and relative lows where it consolidates. So this year, these are the relative highs here, and these are the relative lows here. Now that we have the opening, the midnight opening, you look for the fair value gap that's below the midnight opening. As you can see here, we have no fair value gap here. We have no fair value gap here, but we might have this small one, but this is the most logic one that you can see, is the visible one that you can find when you're looking at this price. So this is where you're going to be taking your execution from this fair value gap here. This is where you take your buy here. So the price didn't get to this, to the true open in this case. So it does it does this sometimes. The price doesn't have to go back to the true open and until unless it has the midnight opening. So I'm gonna make a different lesson when it comes to the midnight opening and the London true open and New York true open and all of the true opens that we have for the day. So basically, this is where once the price take out the sell side liquidity, this is where the you take the buy to attack the buy side. So right here, we'll be taking the buy, taking this buy side liquidity along with this fair value gap here. And remember, we have this range here from this low to the high. The second standard deviation is here, which is the target that we're looking for. And again, to add more on the confluence, you just take your Fibonacci and measure from this low to this swing high here. So why am I measuring this low and this swing high? Because this range here from this high to this low is the one that's responsible for taking out the sell side liquidity first. It took out the sell side liquidity first. Once it did that, now I'm going to be attacking the buy side liquidity and the PDRA above it using my deviations. So now here I did mark the second standard deviation, which is right here. So now as you can see, let me just remove this fib. The second standard deviation is right here. So I'm just going to remove the Fibonacci. Here's the second standard deviation. So now we see we have a lot of confluence in where the target might be, because now we have this range. Here's the second standard deviation from it. We have a buy side liquidity. We have a fair value gap. We have this second standard deviation measuring from this low to this high here. So this is where you actually take your partial if you want to exit the trade earlier. So now that the price has continued to go higher, here's the actual target of the day, and it's on the fourth standard deviation. How did I get the fourth standard deviation? Still, you measure from this low up to this high here, up to this high here. And then, as you can see, we have the second standard deviation, which is here, the first target. Then we have the fourth standard deviation, which is second target. The deviations that I use, I explain more how I use them, why what am I looking for when I'm using the Fibonacci. But I just it needs more time, so I don't want to make my videos to be long. So I just want to make my videos as simple as possible. So this at 5 a.m. This is where the actual exit of the London session it's been covered on. So after then the price did consolidate, as you can see here. This trade here, from if you can take your there's something that we call an optimal trade entry, which is OTE. So you measure from this low, because this low is the low that took out the sell side liquidity, to this high, because this high is the high that took out the buy side liquidity. Then what do we have here, below the 50%? We have a fair value gap right here. This is the fair value gap here. This fair value gap, you the one is the one that you can use for an OTE, the optimal trade entry, which is, I can just put it right here. This is the OTE entry. If you see you're looking for the full standard deviation, you can just take a partial from here, and then from here you can take another entry, the OTE entry, and you can target this the fourth standard deviation right here. So we can see in the same between this time in the interval between 1 a.m. and 5 a.m. we have like two trade opportunities that you can find. We have the 7-11 model, which is from this to that. Then we have an optimal trade entry model, which is from this fair value gap that's below the 50% to the fourth standard deviation. So these two opportunities, you can be able to make money out of them, and you can be able to find consistency, and have it gives you something to look forward to. I also had another comment from someone asking me, uh, how many pips does this model gives? So I just want to I don't know what's happening. I just want to show you how much of the opportunity this price can give you. What's happening now? So from here to this high, it gives you 50 handles. As you can see, it gives you 50 handles from this low to this high. This model can give you 50 handles or more. It doesn't give you anything less than 50 handles, and that's like a lot of money US states you trade with $1 per pip because it's 0.10 the lot size. So you can have like $50 on this single trade from here to here. That's like a lot of money. You can do a lot by following this model every day, making like $50 a day. It can help you to find consistency and profitability in your trading. I'm not saying that every day you're gonna find this model in the pair that you're trading, but you can find opportunity now and then in every pair that you trade. So it's not an everyday thing. I don't want to promise you that you're gonna make profit every day, and if this thing is appearing every day, it doesn't. But you can find consistency in every day when you trade. If it doesn't happen on US30, I'm sure it's going to be happening on GU. If it's not happening on GU, it's going to happen on Forex. So it depends on which markets are you looking at. You need to have a lot of options in your pockets in order for you to find this specific model. But as I've started from day one, we are using the same concept, the same rules, same time, and same different asset class, but the same rules apply, same everything apply. So this is the fourth video. This is part four of the pattern recognition series. I'm gonna be closing up with Bitcoin on Tuesday. So I hope you find this one insightful, and I hope you're able to see how these things repeat every day and how these things gonna help you to find profitability without having a daily bias, without having anything that can confuse your trading journey. If you can start from here, you can be able to find the actual market that you want. You can be able to delve deeper into the market. So on my next project, I want to show you how to summarize the whole thing to find a specific model. So for now, I hope you guys find this thing insightful, and I hope I'm gonna hear from you. So if you have any questions, you can just leave them in the comment section, and I'm gonna try to explain everything that you ask me on my next video every time. So just hit the subscribe button. Once we hit like at least 100 subscribers, we're gonna make live tradings. We're gonna be going live and making live executions and live lessons. I'm gonna be showing my Fibonacci settings because they're the ones that help me to find consistency and profitability and good measurements when it comes to trading. So I hope you guys find this one insightful. Till we talk again on the next video. Have a good one. Cheers.